Started a business, made no profit, but still spent thousands trying to build it? Now what? First, separate the business profit from the tax value. A business can show no profit and still create a useful tax result. Let's say you earned $85,000 from your job. At the same time, you started a photography business on the side. You made $3,000 from clients, but you spent $4,500 on equipment, $2,500 on advertising, $1,500 on software, and $6,500 on other business expenses. That's $15,000 of expenses against $3,000 of income, meaning your business has a $12,000 loss. Now here's where most people get this wrong. They see zero profit and think the business doesn't matter for tax purposes. But that $12,000 business loss can reduce the income from your job that's subject to tax. So instead of $85,000 being exposed to tax, the loss could bring that number down to $73,000. That does not mean you saved $12,000. That means $12,000 of income is no longer being taxed. So if your tax rate is 30%, the tax impact is $12,000 times 30%. That's about $3,600 less tax. And here's something even fewer people understand. If you don't fully use that loss this year, non-capital losses can generally be carried back up to 3 years or forward up to 20 years. In other words, a business loss isn't always a dead loss. Sometimes it's a tax asset. So if you started a business, spent real money, and things didn't go as planned, don't assume those numbers are useless. The real mistake isn't losing money. The real mistake is not knowing whether that loss should reduce this year's income, recover tax from a past year, or protect income in a future year.
Follow the tax mechanic for more tips.